I just want to assure the investors, or I just want to assure you that definitely you are doing the right thing, except that it's going to be scary. Okay. So aside from being optimistic and being greedy today, think about risk management. And I'm sure in a year or two, you will be making a lot of money. I think nobody will argue that the market is currently not doing very well. Well, there are many reasons why it's happening. And one of the reasons would be the high level of inflation, or the surprisingly higher than expected inflation that we're seeing. For example, for the month of August, we had an inflation of 6.4%, which was way above consensus expectations. And the problem with inflation beating expectations is that, and for it happening on a consistent basis, is that it raises the level of expected inflation. Well, high interest rates are negative for the stock market because, first of all, it makes it more expensive for companies to borrow money and expand. Borrowing costs also go up, so that's not good for profits. Also, for investors, there are other alternatives that are much more attractive, like fixed income instruments. Right now, the 10-year bond is already providing a return of around 7%. Historically, the weak peso has been associated with a weak stock market. One of the reasons why we're having a weak peso is also because of contagion from other emerging market currencies. And of course, right now there is a strong favor for the US dollar, given that the Fed is raising interest rates, making it a more attractive currency. Okay, I think what's making things worse for the Philippines is the fact that we have an inflation problem, whereas there are other emerging market currencies that are weakening right now, say Indonesia and India, which are not suffering from inflation problems. Well, at least we now see a more aggressive BSP. During the start of the year, they didn't raise rates right away despite higher inflation, but now there's a greater sense of urgency. They kind of realize that they have to do something about the problem, and they're being more aggressive in addressing it. So I think that's at least a bright spot, and we're quite hopeful that the government will take some non-monetary measures to address inflation, like um, the rice tarification law, or allowing the importation of more agricultural products. Well, SEC has been sold down quite a bit. I think one of the reasons why it was sold down was because of the delays in the rehabilitation. However, first of all, even with the delays of the rehabilitation, they are insured, so potential losses will not be significant or will be offset by returns from the insurance. And secondly, they're an integrated power company, so they also have coal mining. And the earnings from the coal mining business will more than offset the weakness in power. So in that respect, we continue to like it, and we also see insider buying. Mega World, well, valuations are very cheap, admittedly. As discussed earlier, property companies are vulnerable to rising interest rates. Nevertheless, Meg has already transformed itself from being a pure residential property developer to an integrated property developer with a lot of rental properties. So the rental income from its malls, its hotels, and of course its offices, which account for the bulk of its rental income, will allow it to offset potential weakness in residential sales. Yeah, for Ayala Land, we like it. Again, it has a good brand, um, and again, even though the residential properties could be affected by higher rates, Ayala Land has a lot of rental properties also, such as malls. It's actually one of the biggest mall operators in the country, and it also has a lot of offices and also some hotels. So the income from these rental properties will be able to offset possible weakness in the residential sector. In Metro Bank, we like it because it's one of the big three banks. So being a big bank kind of protects you from higher interest rates because you have a bigger share of checking account and savings account deposits, which tend to be more stable in terms of cost rather than time deposits, which become more expensive with higher interest rates. So chances of margin squeeze are much less for Metro Bank. And of course, valuations have become very attractive. I think Metro Bank right now is trading below book value, which is why we like it a lot. We're also seeing some insider buying of the stock. Okay, DNL is a consumer stock that we like because we feel that although consumer companies are more vulnerable to rising inflation in terms of rising commodity prices, rising raw material costs, DNL is not affected. First of all, because the price of coconut oil is going down, and secondly, although the peso is weakening, it has a natural hedge because it also has earnings from exports. So that's it. And of course, we expect the profits to grow double digit this year, which is very good for a consumer company. Okay, Bloomberry is one of the biggest gaming companies in the Philippines. So earnings have grown quite significantly in the past and is expected to continue growing going forward. I think one of the reasons why it was sold off was because it had a bad quarter. But then again, if you look at the operations of gaming companies, they tend to be volatile. Like for one quarter, it could be down, but the next quarter, it picks up. The gaming volume still remains to be very healthy. Yeah, Ayala Corp, it has a diversified pool of investments. So you have banking, then you have telcos, then you have properties, some growth stocks and some defensive stocks like say Manila Water. So we think it's a good proxy for the Philippine stock market. And compared to other holding companies, valuations are very attractive. Compared to historical valuations also, this stock is already trading at a discount. Okay, for PLDT, we like it because we feel like the whole telco sector is turning around because the data business now accounts for more than 50% of revenues. Therefore, the weakness of the legacy business, which includes SMS and voice calls, is less of a drag. And also the threat of third telco, in our opinion, is much less right now because the cost of data is already very cheap. And the requirements for putting up a third telco is very expensive, making it very difficult for the potential third telco to become profitable. Okay, Eagle Cement. Eagle Cement is our preferred pick for cement companies because it's the more efficient cement company. And based on what we're seeing, there is the bottoming of cement prices. And of course, the demand for cement is picking up because of the government's Build program. And from the private sector also, there is strong demand for construction. Okay. Well, we don't think that it's expensive, despite the correction. We have said numerous times in the past that, first of all, using the PE ratio for the PSEI is not the proper way to look at it, because the components of the PSEI today are no longer the same as 10 years ago, 5 years ago. What we did was we looked at each and every individual stock in the index, and based on our assessment, 20 out of the 30 constituents of the PSEI are now trading below their 10-year historical averages, making them really very cheap. The market will not be cheap unless there are problems, there are uncertainties, and there are concerns. So, but that doesn't mean that the market is not cheap. It just means that yes, maybe it will continue to go down, but this also creates the opportunity to make a lot of money. Like Warren Buffett has said, if you buy a stock now, it has to be something that you're willing to sit on, even if the market were closed for 10 years. I think it's a good opportunity definitely to buy, because stocks are cheap. You know, the problem is, of course, we don't know if we've seen the bottom already. Um, but then we definitely know for sure that we're seeing values, and once conditions normalize, we're quite confident that valuations will be higher than where it is right now. Okay, so I think the best strategy is, again, to make sure that you just have enough stocks. In terms of value, this would be a value that you can stay invested for the long term, that you won't need in the next year or two. And also to do it slowly, because as markets continue to weaken, we want to be able to buy a little bit at a time, so that if ever, your average cost can go down. Well, maybe the next 6 months you could allocate your buying into maybe 6 tranches, and you could put a certain level of discipline. Say, I will only buy if the PSEI is trading below 7,500, something like that. Yeah, definitely the market is I guess scary. I mentioned two Warren Buffett quotes. The first one is to be greedy when others are fearful. And in my opinion, this is the perfect time to be greedy. However, at the same time, when you buy stocks, buy something that you're willing to hold on to for the next 10 years. So this does not only apply to stock selection, but also in terms of managing your risk. Okay, because of course we now know that if you buy something and the market goes down, you might question yourself if you're doing something right, or if this is the right strategy. I just want to assure the investors, or I just want to assure you that definitely you are doing the right thing, except that it's going to be scary. Okay, so aside from being optimistic and being greedy today, think about risk management. And I'm sure in a year or two, you will be making a lot of money.